Just right before we get into the speaker, I'm not even gonna bother putting this up, but it's just our announcements. We were supposed to have one of the fellows from the Bowley Center come talk about the women's stock pitch. She's not here, so what can you do? But just some important things. The Eldridge position we've been talking about for the past couple of weeks, that's going to close on the 19th. And they're doing, I believe, in-person campus interviews on something like the 22nd. So try to hit it before the 19th so you can actually be considered. You know, we talked about this before. It's Bowley's private equity firm, essentially. And I think it pays like $52.50, or that's what they're aiming at. So, and this is an internship. So if you need anything else, any more reason, there you go. One last thing. Cornell's 2023 Undergraduate Stock Pitch Challenge and their own sort of Women in Business Summit is happening actually in the fall, but you have to apply by the 28th. They reached out directly to me, somebody from the Cornell Business School. This is a great opportunity. This is going to be watched by recruiters from various investment banks, private equity firms. So it's a great opportunity to show what you know, learn a lot, get involved in equity research and the actual presentation part. Again, this is going to happen in the fall though. I will be emailing out more information. There's specific links they want you to go through, including the Eldridge position. There's a specific form they want you to fill out. But those are my only announcements. So might as well just get into it.
All right, let's see. All right, Zach can't see me, but thanks everybody for coming today. This is probably going to be the last you'll hear from me unless you want a tour of the EC after. But Zach already gave you guys a bit of his blurb, what he's about, and I believe he has a few slides, and then we'll get into Q&A, which Spencer will moderate. And the last thing I'll say about this is don't be nervous asking questions. Zach has a lot of experience in pretty much all the fields that he's ventured into, whether it's being a lawyer, being an investor, or being an entrepreneur. This is a good opportunity. Don't let it slip. So with all that pressure, Spencer, I'll let you take it. And this is a much more fun mic. So you can go.
Yeah, this is the best part. You can throw this mic around the room. Thank you, Zach, for being here. I know we're all really excited to hear from you. Yeah, as Miles was saying, I think one of the reasons it's such a great opportunity is the business school does do a great job in preparing us. But I don't know, in most of your classes and at most of the events, they're kind of going to treat you as they would an analyst, or they're preparing you essentially for being an analyst in an entry-level position. They're not really preparing you for being a leader in your field or being a self-starter. So I think that's one of the best opportunities we have here today, is hear from somebody who has started so much and been so successful. So thank you, Zach, for being here.
Yeah, thanks for having me, guys. It sounds like you guys have a lot of good opportunities, internships and stuff like that. So that's awesome to have those opportunities. I don't know, do you guys have my PowerPoint, or should I pull it like screen share?
Yeah, screen share, I think. But if you could wait 5 seconds, there's some music playing in the background.
1 second. I just put together something quick. Let me pull it up real quick. Oh, it says disabled. You guys disabled screen sharing. So I think Miles, you might have to give me some access.
All set.
All set.
Okay, sweet. See. Okay. So my name is Zack Oliva. Thanks for having me on. I probably took a much different route to investing than other folks that you guys have talked to. So just a little bit of a bio. I was born and raised in Youngstown, Ohio, and I live in Houston, Texas now. I went to Ohio State for undergrad and Capital University for law school, which is also in Columbus. In 2013, I co-founded this law firm, which is in Houston. We've got offices around the country. Got about I think 30 or 35 lawyers that work at the firm, primarily in the oil and gas industry. So we represent oil and gas companies and transactions. And we just started a litigation practice this year. Co-founded Eiffel Trading, which was an online marketplace in the construction industry, which is still just absolutely crushing it. And I exited that business in 2018. And I founded Oliva Partners, which is an investment fund last year, which I also manage. Oliva Partners is technically a hedge fund. I call it an investment fund. And basically, I formed it to manage my own capital, as well as the capital of other limited partners in there, mostly entrepreneurs. And I try and buy cheap stocks and not do dumb stuff, which is harder than it sounds for someone like me, I guess. I've been an entrepreneur for about, I don't know, I started my first business when I was like 10, but I've started businesses that have actually made money probably over the last 10 or 15 years. And I put together a little lessons learned slide, which we can go through. And I've also been an investor in the equities markets for, since the Berkshire Class B shares came out in the 90s. It was my dad kind of taught me about investing that way. And I was maybe 10 or 12 then, and have always been invested in the public markets. And my style's changed a lot over the years. And yeah, it's a lot of fun. I mean, I get to build businesses and invest and build in a hedge fund right now. I'd like to start and see if you guys have any questions, and then maybe I can work in some of these lessons from that. I would say that the style of investing that I do is probably closer to a Benjamin Graham style of investing. I tend to buy things that are super cheap, below liquidation value. I think that probably as a small investor, the biggest edge that you have over the market is the fact that you're a small investor. So investing in smaller market cap things where, large hedge funds or index funds can't invest in has proven to be pretty rewarding. And I also am a big fan of investing in businesses that I would like to run myself. So, businesses that I can understand, businesses that are really easy to understand, which basically, I don't look at pharmacy or pharma stocks. I usually don't look at insurance companies. I usually don't look at technology companies. And I just kind of stick with really easy to understand businesses. And that for me has really worked out well over the years. But I think that the most important thing is to experiment with many different types of investing until you find a style that clicks for you. I have friends that are really interested in technical analysis, which is cool. I have friends that are really interested in options trading, which I'm not, but it's so I think that the most important thing is you find the style of investing that works for you. And you guys are doing a great job right now by cultivating a peer network of investors and other folks that share an investing passion. I get so many ideas from the network that I've created over the years, and it's really good, especially when you're running your own fund for someone like me, to have someone to talk to and to help you, not make decisions, but identify blind spots that maybe you didn't think about. I have found that when an investment is a maybe, it's usually a no, or it should have been a no, and it was a mistake. The great ideas that I've had are usually so amazing that I think, sometimes I think I got it wrong. And then when I dig deeper, I realize like oh my God, actually the market got it wrong. And those have tended to work out pretty well. And I'm a big believer in outperforming the indexes by just a small amount. So I think historically my performance has been really good. I've outperformed the S&P, pretty much doubled the S&P over the last 7 years. Last year the fund was down, I think 3%, and the market, the S&P, which is my benchmark, was down about 18%. So for me, a down year is actually a win when I did less worse than the market. And if you take that math and you do it over a long period of time, those returns add up to a significant amount of money. Yeah. Are there any questions or anything that you guys are working on that you have questions about?
How many people have questions as of right now? Okay, then let's just go straight to questions. Go ahead.
Hey, first of all, thank you for taking the time to come here and talk to us and kind of share some insights and your experience. I'm Nicholas Wozniak. I'm a sophomore studying applied math, interested in trying to get into like the investing field to the buy side, and just wanted to ask about your strategy. Like you say, you invest in kind of firms at a discount, firms you can understand, kind of small business models, avoid like really complicated, let's say like niche tech startups or whatever.
Sure.
And so how do you kind of ensure you have like low correlation of the assets within your portfolio, as well as like low beta, in order to make sure you're not like just kind of, and it's like low beta, low correlation to, let's say, the overall S&P 500. How do you kind of control those things if you have this relatively limited group of stocks? And then a second question would be, out of curiosity, why did you never kind of go for like using derivatives, like calls, puts, or whatever, to kind of maximize your returns?
Those are great questions. Thanks. So how do I make sure that there is not that much correlation in my portfolio, or in the fund's portfolio? To be honest, I really don't even think about it. So I don't really worry about correlation or beta, and I never have in my portfolio. I think that it's rare that the entire portfolio would be invested in the same sector at the same time. An example would be, okay, during COVID, there were, the market was doing really weird things during COVID, and there were some interesting opportunities in oil field services. You could buy some oil field services companies at a discount to the cash that they were carrying in their investments. Some of them had little to no debt and were still profitable even during COVID. But I didn't find a ton of those, right? So I only found one or two of those. And then a sector that is kind of getting destroyed right now is home building or building supply stocks. If you go in and I look at the home building and building supply stocks that are on sale, then there aren't a lot that meet my criteria of being like ridiculously cheap. So also when you're doing, I guess I would call it maybe portfolio construction or investing, you say you have 12 positions in there. Those positions may have different timelines. So there may be some companies in there that you got a really great deal on that are amazing companies that you want to hold on to for a really long time. Those are rare, but those are amazing when they happen. There may be some other companies where you know that, hey, this is probably a double in the next 2 years or the next 3 years. And then I'm going to move on to greener pastures and see what else is out there. So I think that for me, at least my experience has been that I haven't really had a correlation risk, but to be honest, I really don't think of it that much in the fund. When it comes to derivatives and why not using them, I'm a pretty simple guy. and I'm not incredibly bright. Like, I mean, if you're doing applied math, you're probably insanely more smart than I am. What I do have going for me is psychology, which is something that I can control. So, you know, when I find an investment, I buy into it, and then I just let it sit and come to fruition for a year or two, or however long it takes. Sometimes longer, which is painful. But and I just wait, and then sometimes, you know, things tend to go up in a really ridiculous fashion. But generally, it's slower than you expect. So you're actually the third person in the last month to ask me why I don't use derivatives to kind of juice my returns. So I should have a better prepared answer right now. But I don't like to make things too complicated.
Okay, well, thank you.
Yep.
Yeah, and thank you for the answers, and anyone else?
Thank you, Zach, for speaking with us again. My name is Michael. I'm a freshman. I had one quick question. So I listened to your podcast or your episode on the We Study Billionaires podcast. And you mentioned when you were looking for stocks that you tried to find companies that were unloved or had like an unloved story behind them. So I'm curious, with that perspective, what do you think of ESG investing?
So in addition to, you know, investing, I also manage a law firm in the oil and gas space that represents oil and gas companies. I think that ESG is I think it's a fad. I think it's a way for people to raise money that was very successful. I think that I haven't seen a direct correlation between ESG companies and investment returns. There are companies out there that do terrible things to the environment that make a lot of money. I think that on the ESG, the governance part for me would probably be the most important. But I largely think that ESG is kind of a fad, and I'm actually surprised at how much money has been dedicated to it, given the lack of evidence that ESG, if you look at ESG specifically as investment criteria, I think that it's interesting that it's attracted that much capital. I could see why Bitcoin attracted that much capital, because everyone was getting rich, right? So it's like moth to a flame. Of course, you're going to throw money into Bitcoin. But I was surprised that ESG attracted as much capital. Now, that being said, you know, I think you should probably not litter and take care of the environment. But would I put my money into that? Not necessarily.
Thank you.
Yep.
Hi, Zachary. Thank you so much for coming and talk to us today. My name is Alicia. I'm a junior studying finance at this school. I think it's really interesting and really incredible what you've done. In terms of your answer to Nick's question, I'm just wondering more, like, do you have any advice for students who might not have the resources or income as like somebody like yourself who was able to gain a lot of income just based off of your law firm? Like, I understand that maybe you had more room to make mistakes and more room to fall back because of, you know, you were able to already become so successful with your law firm. But I'm just wondering, like, what sort of advice would you have for college students who may not be at that state in their life where they have a lot of freedom to make mistakes?
Thanks for your question, Alicia. Is your question about I just want to make sure I heard it right, how to get capital to invest, or is it more on how to get capital to become an entrepreneur?
Both, yeah.
Both? Oh, okay. Trying to think. So saving is a good way. That's how I started. It's not, you know, I'm 37, but I've been a saver since I was a kid. And I've kind of slowly saved a lot, and that helped me make a lot of money as well. If you're just getting started and you're interested in investing, I think the best thing to do is to give it a try. You are young, you have a long road ahead of you, and now is actually when you can afford to make a lot of mistakes, and you're not gambling with a ton of money. I've learned that the lessons that I've learned in investing from mistakes that I've made, from going to the Berkshire Hathaway conference, for example, and surrounding yourself with great people. The people that generally are interested in investing are also generally interested in personal growth. And so just by surrounding yourself with those kinds of people, you're already creating a significant amount of future value, because those people are going to help you out in the future. Other than that, I would say, if you have rich parents, that's awesome. And you should definitely take advantage of that or work. But I mean, I started, I put myself through school and built everything, including the startup online marketplace and the law firm. When I started, I used up, my entire savings accounts to get those started. And that was after I'd have only been working in the real world for about a year. So, I think that the quickest way to wealth for in America is probably to start your own business. And then if you also become a great investor along the way, I think that's, you add some serious horsepower to your personal net worth.
Did you have rich parents?
What's that?
Did you have rich parents?
No, I did not have rich parents, but I had something better. I had awesome parents. My mom was a teacher, so she made me read all the time, which is a great, hobby to pick up. And my dad was a really great engineer, and he, worked for the government. So we were by no means rich, but he was really interested in investing. So I think the fact that he taught me that at a really young age was really helpful. I mean, I started learning about investing and Warren Buffett when I was like 10 or 11. And as you know, Buffett is like the man. So picking up life lessons from him along the way was excellent.
Thank you.
Hello, my name is Richard, and
Hi.
now I'm studying business finance, and I wanted to ask, what would you say is, like, in your opinion, since you seem to focus on fundamentals versus technicals, what do you think are like the advantages of focusing on fundamentals of a company versus technicals overall? And also, slightly unrelated, or kind of like, what would be some common pitfalls for beginners from your view?
Thanks for the question. On fundamentals versus technicals, I think that the advantage with fundamentals is that you can understand how the business actually makes money. And also you can understand from the fundamentals if the business actually has money. So there is an investment newsletter that I get every week called Value Line, and every week it covers a few different industries. And the tech, one of the industries that's broken out, the subset is e-commerce, for example. And I flipped through there, and every company in the e-commerce sector was trading at a PE of like 40 or above, and actually was losing money every year for the last 10 years. And I can tell you as a business owner, obviously much smaller than a tech company, but I've seen this play out time and time again in the stock market as well. I think a really good, I got on a slide here that I'm not sharing with you guys. Let me find the slide. A really good saying that I like is revenue is vanity, profit is sanity, and cash is king. So with the technicals, you can't really understand the company's cash position. maybe technicals, there are people who do very well day trading with technicals. I tend to check, I check the market once a month, maybe every 90 days to see what our positions are doing. I don't really look at the market every day. If I did, I would probably, maybe freak out. And so I think the fundamentals are good. I look at public businesses as if they're private businesses. So I've invested in private businesses before. And the first place you start when you invest with private businesses is you start with the balance sheet, you start with the income statement, and you look at these businesses as they actually are today, not based on what the private market expects them to be, 5 years from now. Common pitfalls in investing. A mistake that I made was investing in something that was popular. Like, I don't know, 15 years ago, I read about this oil company on the Motley Fool website. And I was, they said there's no way you can lose. And so I was like, oh, of course, why would these people say anything other than that? And I put money in that, and the company like immediately went bankrupt. So that was not awesome. Another common pitfall is getting talked into things by, friends or investors or family members, or, the main thing about stock tips is you only hear about them when other people believe in them. And everyone loves to tell someone about a hot stock tip. I've usually, when I was, much younger, I would sometimes pick up on those, and that was dumb, because it was ignoring a lot of the criteria that I had already built out. Other common pitfalls that I've had have been selling too soon, which I don't think any investor has ever. I think every investor, faces that. There's a company that I bought into through the fund, maybe like last year, the year before, and it went from $1 a share to $14 a share. And then I thought, this is amazing. My luck is so good. I mean, the company was hugely undervalued. It was called support.com, and they basically provided outsourced support services for companies like Comcast and AT&T. I think they were trading at about $1 a share. I think they had a few bucks a share on their balance sheet, and nothing really wrong with the business. It was just really undervalued. So that company shot up to, I think it was around 8. It was around $8 to $12 a share. It just kept going up. And so I sold. And then, the next month it went up to 54. So that was a huge mistake. And it went up to 54 because they got bought by a Bitcoin company, out of all things. For absolutely, I could not figure out the reason why this Bitcoin company wanted them, but they got bought by them. So sometimes things happen where you're like, I shouldn't have sold. So, what was my best investment actually became my worst investment, because I sold. So, that's something that I think you just learn with experience. And another common pitfall is, I think, not wanting to make any mistakes. I understand that it's, your hard-earned money, and you want to get it perfect. And especially because you all are obviously, at William and Mary, you're all super high performers. So I understand wanting to get things absolutely perfect, but the experience comes from making mistakes. And those are the lessons that you learn the most. I think that we have a natural bias towards, when we get an investment decision right, even if it's for a ridiculous reason that the stock goes up, you think that, this is amazing. And I was completely right about this. But oftentimes I find that things take longer to work out than anticipated, or I've made a big mistake. I mean, I've definitely made mistakes in investing, especially when it comes to special situations. I'm probably not the best special situation investor. But I wouldn't have learned that without, making some mistakes that fortunately weren't too painful, but they were enough to make me wake up and go, oh shit, what did I do? Why did I make that decision? And kind of evaluate your decision making on that.
Right, thank you.
Hi, Zach. My name's Tiger. I'm a junior studying finance.
Hi, Tiger. Sweet name.
Yeah, thank you. So I think, well, this is one of probably the largest, you could even argue the only valid criticism against value investing. And it is value trap, right? People say if the PE is so low, there must be a reason. The market is anticipating the company is going to go into decline. So how do you guard against the risk of value trap?
That's a great question. It's good to look at competitors in that area, in that sector, or against, whoever's competing against the company that you're looking at investing. Maybe there's something that you're missing, so that could help fill up gaps in your intelligence. Also, it's good to talk to, seasoned investors. There's a few guys that I have in my network that I've, become good buddies with, who are kind of the gray hair investors who run, pretty large funds, and they've seen this stuff before. So it's always good to bounce ideas off of, folks like that to help you out. And sometimes be open to the fact that you're right, and the market could have gotten it wrong. There's a lot of low PE stocks right now in the building supply sector, based on the fact that people think that housing is going to fall off a cliff. And the people that are selling those stocks think that housing is going to fall off a cliff. And there's people buying those stocks who think that housing is not going to fall off a cliff. So, I've seen macro experts get it wrong. I work, a lot of my work is in the oil and gas industry. There's folks who are really, really bright who think that oil is going to go to 300. And there's folks who are really, really bright who thought that natural gas was going to be at $10 right now. And it's significantly below that. I think it's around 2 or a little bit below that right now. So sometimes folks get things wrong. I mean, you're smart. If you think that you figured out the problem, then I think just see what happens.
Got it. Thank you. That's really helpful.
Hello. Once again, thank you so much for your time. My name is Jung Hoon, and I'm also a finance major, going to graduate in 2024. But well, I have 2 questions. One question is on your slides. Like, I saw that you look at the earnings and like liquidated assets, what the company, if it's undervalued. Then one question that brought up to me is, then do you also look at like the book value of the company when you also buy into the stock, such as like the PB ratio? Like if it's like a liquidation, let's say that the company's trading like way below, then it should be according to its book value. Do you also like consider into that? And another question I wanted to ask was that when you like brought up the idea of like you also look at the business model when you look at the stock, like how Warren Buffett or like Charlie Munger, the investors trade. Let's say that their financials are really good and like, but you really don't understand the business model, but like everyone says like the earnings will be good, then do you not buy into it because you do not understand the business model, or do you still buy into it because the financials are good?
Thanks for your questions. On the earnings and assets, and I think your question was, do I look at the book value or do I look at the PE ratio when I'm looking at a stock? Is that right?
Yeah, like, do you also like, I would say, I feel like earnings is important, but do you also look at like the book value?
Yeah, so earnings and asset, I'll put book value in the asset category. I think you can buy cheap earnings or you can buy cheap assets. Both work out really, really well. Earnings tend to fluctuate a lot, and assets fluctuate. I mean, if you have a bunch of plants and equipment and things in inventory, that fluctuates less. So I like assets because frankly, I'm kind of slow sometimes. So it gives me more time to evaluate situations rather than, trying to buy earnings and there's an earnings miss. Now there's ways, like in the Intelligent Investor, I think Ben Graham recommends evening earnings out for like the past 10 years and taking an average and doing it like that. I think book value in most industries is a good indicator of potential undervaluation. So it's a filter to use. If you can buy, companies around book value that are earning, 20% on capital a year, it's going to work out pretty well for you. So I use it as a factor when I'm looking at it, but you have to take into account the totality of the business, which is why I really enjoy using Value Line, because on one sheet of paper, you have a 10-year picture of the balance sheet and the income statement right there. And so you can look for inconsistencies in that data. When it comes to a business model that I don't understand with great financials, I'll usually skip it. And that, I usually will skip that business unless it's so undervalued that it almost, you're basically just buying the balance sheet. There are situations like right now, and there were a lot of situations in Hong Kong when they were having the protests about China. There were a lot of really undervalued companies in Hong Kong. Japan tends to be a place to find really undervalued companies. Poland right now, because no one knows what's going to happen in Ukraine, that tends to be a place where you can find companies trading at a third of book value or 25% of book value, or just some pretty insane, valuation. So that, as a small investor, I think that's where you want to stay. Now, they can be very volatile names in those areas, and you have to be, have the fortitude to stick through it. But I think generally, if you buy a basket of things that are significantly below book value with really good, balance sheets that are temporarily unloved, it tends to work out pretty well. There's an investment bank called Tweedy Brown, which you guys may be familiar with, in New York, and they put out a study a few years ago. It's called What Has Worked in Investing. It's just a PDF you can look up. And they studied investing since like the 1900s and all different types of strategies. And the two strategies that they found to perform the best were, shockingly, buying things for less than asset value or buying earnings for less than their value. So basically, when you buy cheap things, I think it works out pretty well.
Thank you.
Yeah.
Hey, I'm Owen. Thank you very much for your time. I'm a freshman here, planning on studying finance. So as far as the selling point on investment, I know like Benjamin Graham talks about once it goes up about 50%, you should sell. More about this kind of like the P ratio is about 40, you should probably sell. Do you like use either one of these? And if not, like what's kind of your indicator of when you should sell an investment?
I think it's really dependent on the situation. My life would be a lot easier if I had a hard and fast rule that I stuck to. Because then it's just a formula, right? It's just an algorithm. You just do it. But there are companies that I've owned where I haven't sold because I thought that the future looked really, really bright and I wanted to hold on to it. And there's other companies that I've bought where I've made a lot of money and I thought that the future, didn't look so bright for that business. It did look bright when it went up a lot, and then I thought that maybe the future didn't look so bright. So I tend to, before I make a selling decision, I tend to reevaluate the business again and compare that against other businesses that I am looking at or that I own to see if there's a way if there's somewhere to park that money.
Thank you.
It's me again. So you talked a bit about like housing is getting kind of like taking the smash the last like few months especially. And so out of curiosity, and you, especially as someone who's like had all this experience like the oil and gas industry, I'm sure you've seen that like there's a lot of cyclicality to a lot of sectors like housing, oil and gas, like housing basically, the housing falling, right, like predates like every economic contraction. So I'm kind of curious as to why, have you ever considered incorporating ETFs to just like try to take advantage of, let's say, a general fall within a sector that like almost certainly will rebound within, 1, 2, 3 years?
Hmm.
If like, no, like why not? And yeah. That's the first question. Then I have a kind of unrelated one after that.
Okay. I've never considered ETFs. I just prefer investing directly in the individual companies that are undervalued. There are professional managers that I know who I think instead of doing, some of them will do ETFs, but others will just buy a basket. So they'll buy an undervalued, basket of tanker stocks or oil field service or home builders and, maybe create their own ETF that way. But I generally tend to invest directly in the actual business.
And that's just like a preference thing to make sure you're getting the absolute, like definitely undervalued assets.
Yeah. I just prefer to do it that way.
Okay, makes sense. And then second question is, you talked a bit like the advantages as a small investor, like you can look for things in like Poland or with like small market cap or like companies with, let's say, like $10 billion market cap instead of like the Apples or Microsofts. So what level of like market cap, and it's interesting because when I pitched stocks to the investment club, and both of the ones that I pitched were like really small market cap, like under like 10 billion US dollar range. And so just what do you think, like kind of like amateurs like us, let's say, if we're trying to just like look around, get practice, trying to identify good companies, what like range of market cap could we be looking at to make sure that we could be looking at something that doesn't have, like 100 analysts on it already, and like really finding kind of inefficiencies?
Yeah. I think that when Buffett first got started, I think a lot of the investing that he did was pink sheets, which is basically the OTC market. And I know, it's amazing the people that you meet in investing. There's, a lawyer that I know here in Houston who just absolutely crushes it, and he only invests in the OTC market. That's the only thing that he does. Nothing that's actually publicly traded or publicly listed. I tend to focus more on $100 million and less. There's a few exceptions to that if a larger company is exceptionally undervalued, but I generally, like that. I think the smallest that we've invested in has been maybe a $16 million market cap company that actually turned into like an $80 million market cap company. It was so undervalued. But that's kind of just what the market does sometimes. It's rare, but it does happen in those, especially in those industries.
Okay, that makes sense. And it's funny you mentioned things. The last stock I pitched actually is listed on the OTC markets.
Yeah, it's a good. I mean, those are real companies, right? You got to do your due diligence on the owners of those companies.
Thank you.
Before I go, is there anyone in the back who wants to ask a question?
Hey, thank you very much for coming and spending time with us. My name is Ryan. I'm a freshman here studying physics. I just wanted to ask you, Phil, on one of your slides, you mentioned importance of hiring and retaining A-level individuals. I was wondering, is there a commonality you see in the mindset of those people, or how do you define that as a person? What do you look for when finding those kind of people?
When hiring people?
Yeah, but when hiring, you mentioned the A-level individuals.
Oh.
Curious, with a little bit more about what you mean by that.
Sure. It's a great question. So I think an A player really is going to depend on the role, right? So if you have an investment banker versus a lawyer, those A players might look a little bit different. At our firm, we tend to lean heavily on substantive knowledge, culture fit, and extensive reference checks. That's kind of, one of the ways that we define A players. I think that probably there's a really good book called Who. And it's all about hiring A players. And so if you read that book, then maybe there'd be some really good questions in there that probably the top firms use either Who or top grading, which is another interview process. And if you know the questions those would be the questions that probably the top firms would ask, and maybe what their interview process would look like.
Thank you. Hey. Hey, thank you for coming out tonight. My question was just, how much of your portfolio consists of net nets? And you've mentioned Value Line, you also mentioned Net Hunter on the podcast. So what other tools do you use, or is that mainly it?
I think that probably the portfolio, our fund probably has about 60% net nets right now. And the other 40% is either great businesses that I found that were on sale or a special situation.
Okay, and then the second part was, you said you don't use screeners, correct? So how do you go about finding them?
Yeah, I don't use screeners. I go about finding those by just reading Value Line and paging through, when my daughter goes to sleep, I just hang out with the dog and kind of page through that stuff and look for them. I also have, the network part is really helpful as well, because if you have investing styles in common with people, they're going to alert you to situations that maybe you might have missed. So that's really helpful as well. Yeah.
Thank you.
And I wanted to go back to Alicia's question real quick. Alicia, I thought of a much shorter answer about, what would you do if, I think creating the income to be able to be investing. I mean, I think the answers are get a really high paying job or start your own business. You don't have to create the next Facebook to make a lot of money as a small business owner. You can just find a business and copy it and just decide to do it a little bit better, usually through customer service. I have friends who, started their businesses with $10,000 and now they're making 2 or 3 million a year. And they have, 10 employees and their life is great. So with a small amount of money, the great thing about this country is that you really can do anything that you want. And I would highly recommend, I know a lot of you are probably, B school focused or focused on investment banking. And I would just encourage you to also think about entrepreneurship as a career path, because I think it's a way to really shortcut wealth creation.
Hi, I'm Alex. I'm a junior here, finance major. On your slides, you said to avoid the margin. And I just wanted to see if you could talk more about that.
Yeah, I actually couldn't hear you. Would you mind?
Oh, sorry. I'm Alex, a junior here, finance major. And my question was, on one of your slides, you said to avoid the margin. And I'm just curious as to why that is.
I've seen bad things happen with margin, especially during COVID. I think generally a lot of debt is, I've not seen that work out well for people. I think that in my experience, there are ways to really increase your returns using debt, but if you're wrong or you mistime that, it leads to really poor results. And so for me, you can outperform the market by a small margin over a long period of time and end up really, quite wealthy. And I just wouldn't want to risk it by using margin and mistiming the market or getting it wrong on an individual stock.
Okay, thank you.
Mm-hmm.
Hello, hey again. I just wanted to ask, since you tend to focus more, like you know, you don't focus on the day-to-day fluctuations of like the market or the stock price. I was wondering what your thoughts would be on, like strategies that kind of follow that philosophy, like something like dividend investing, or just focusing on like do dividends of companies ever factor into your decisions? How does that play in your kind of strategy, basically, if it does at all? Or what your thoughts on it overall?
Yeah, dividends are great. I have two dividend stories. One is a company, oil field service company, a few years, this is probably 10 or 15 years ago, that I invested in. The dividends were like 80%, and I was like, this is absolutely insane, what's going on here? And I did a very poor job of analyzing that business, and they quickly just took all my money. And I think that the managers, it would be gratuitous to say that they robbed the shareholders of everything in that situation. Another dividend story is that there's an oil and gas operator based out of London that I invested in, and very well run business, great management team, historically very strong balance sheet. Because of where they operated, they really didn't reinvest much, so it tended to throw off cash at about 40% a year. And so that worked out really well for me, and it was deeply, discounted when I bought into it. So I think with dividends, you have to peel back the onion a few layers and figure out, what's going on. But also, there's also weird situations that happen. Like I think 10 years ago, AT&T was trading at like a 9% dividend. And obviously, like, I think they made some bad acquisitions, but if you lock in that dividend at 9%, like AT&T has more customers than the entire continent of Europe. So they're probably not going to go bankrupt anytime soon, right? But I do think with dividends, you generally would rather see that money reinvested into the business, either through improving the business or buying back stock. It's rare that businesses can't find anything else to do with the cash that, actually a lot of times they do dumb stuff with that cash. But I would just peel back the onion a couple of layers and see what the story is. Yeah. But I've been in situations where you're like, you look at some dividends and you're like, oh man, this is insane. And you just start counting the dollars, and it's attractive, but yeah, just do some investigations into it.
Any thoughts on companies like REITs or BDCs that specifically focus?
Did you ask about REIT? Sorry.
Yeah.
No, I think I saw Monish Pabrai recently bought in. I think you guys have had him. I think he recently invested in Brookfield. I know they're a real estate asset manager. I haven't really invested in any REITs. Blackstone, I read, has a great non-publicly traded REIT. I think it's called the BREIT, that has historically paid like 11 to 14% returns. But I think that you need to be like a qualified client to get into that. But I recently read that in the Wall Street Journal.
All right, thank you.
Thank you, Zach. Again, I'm sure we all have a lot more questions, but I'll just ask one more for the club. And that's, where can we find more about you and just keep up to date with what's happening?
Oh, sure. So if you just go to olivapartners.com, I think there's a way you can sign up for a newsletter that goes out usually like once a month. The annual letter will probably be going out in the next week or two. And then I occasionally write on there as well.
Great. Well, you have a law firm and an investment fund to run, so thank you so much for taking the time.
Yeah, I appreciate it. If you guys ever need anything, just ping me. I think Miles has my email address. Happy to help you guys out. And I think that probably, if you guys are in investment organization, you're probably ahead of 99% of your peers across the country. So, hats off to you guys on getting involved this early, and expect, great things out of you guys in the future.
Thank you so much for tonight.
Thanks, everyone. Have a good one. Bye.
Alrighty, well, that concludes the meeting.